You went into Friday's jobs report with the firm belief that the market was pricing in too much Fed easing. What do those Labor Department data mean for the July meeting and Fed policy through the end of the year?
Okay. Well, thanks for having me. I'd start just by saying I think the market got too dovish on the Fed. I think the idea that they would do 50 basis points in terms of easing in July is too optimistic. I mean, ultimately, the Fed sees low inflation, and I think they see slowing growth. And so I think the prudent thing to do is to do 25 basis points. So when we were talking ahead of the jobs report, that was kind of where we stood. And I think
now the market's kind of come around to your point of view.
Yeah, I think we're playing that out. Look, there are very few times, there are only, I think, 3 or 4 times in history where the Fed funds is more than 50 basis points above the 2-year. And every time that happens, the Fed eases. And so the market...
This is a key point. I'd like to bring up a chart that illustrates this. We can show everyone what's happened in the short run. Amazingly, some people may have missed this divergence between the Fed funds rate and the... here we are. This is what's happened year to date.
Yeah, so when the market, when it gets like that, this happened in 1989, it happened in 98, 2000, and 2006. Almost all those times you had very slow growth over the next 12 months, and the Fed was trying to needed to start to get ahead of the curve. 89, 2000, 2006, and 7, it got bumpy. 98, it actually, the market ripped to the upside. I mean, our view is we're not going to have a nasty recession, but we also don't buy off on the case that we're going to have a big 1998 to 2000 run up. So
that's the big question, though, right? It's, does this look like 89, right? Yeah. Does it look like 98? Does it look like 06? Or does it look like 2000 when instead of having equity markets substantially higher 12 months hence, you actually had a major correction?
So let's walk through those. I mean, to me, the case that it's 2007, that companies are over-earning abnormally, I don't see that. 2000, you had a valuation issue. And 89 to us probably wouldn't be a bad test case, which is you bumbled through and you made it through. The central banks ended up getting dovish, but you had some corporate profitability issues. And so I think if I was to quote Shakespeare, it's kind of full of sound and fury signifying nothing, which is ultimately we think the market is capped on the upside by multiple, that you won't get any more multiple expansion from here. But on the downside, you do have what I would say is a protective Fed, as well as some of its peers in the global central banks.